all of your money that you put through the whole life, all the cash value is always earning interest and dividends, whether you take it out or not, whether you have it in there or whether you have it all loaned out to pay off debts, you're still earning all of the interest because these are non-direct recognition companies. You didn't save any more money, you didn't take on any risk, and you didn't work any harder for this. This is the same dollars and cents. Nothing changed except for where the money went first.
We not only help you at the beginning, but through the entire process and for literally the rest of your life. That's the most important aspect of all of this, is how you move that money, and they're right there to help you do that.
Welcome back, everybody. Another week, another wealth webinar. We are going to really dissect the infinite banking concept today, but we're going to add two dynamics to it. And they are not the lazy cash who conveniently, literally has it figured out that every time we go live, he pops in and then he pieces out. I mean, wouldn't that be the life? You come in for the best part of the show, which is the intro, and then you're like, all right, I'm going to go sleep. Man, he's got the life. But what we're going to talk about is your life. And we're going to talk about first how to create wealth through your own debts and expenses. You see, we've been working really, really hard behind the scenes. As a matter of fact, one of the guys on our team, Mr. Craig Yenny, the spreadsheet wizard, we got lots of nicknames for him. He's working on something brand new, which I'm not going to show you today, but I'm going to just give you kind of a look into the future of what this can kind of do and how it can work. It's a software that we're basically creating, a software that will allow us to do anything we want with the infinite banking concept, but show you what it actually will do to solve your problems. Instead of us telling you or giving you concepts or giving you this hypothetical, this software, which you can actually use, because everybody says, hey, is there a software that we can get that will show how this works? Nope. You got to go through the process and do this. But now we're creating a software that's going to literally allow our team and eventually you to then see exactly what the infinite banking concept will do for you mathematically. You literally get to drive the car before you buy it, if you will, and see that that car performs exactly how you want that car to perform. What I first want to do is I want to kind of just frame it up, and I want everybody to just play along with me. We got 132 people. If you were to add up all the checks or bill pays that go out of your checking account on a monthly basis to someone else's bank, credit card payments, home equity line of credit payments, car payments, or car lease payments, whichever way you want to do that, any debt that you write a check to, if you were just in your mind, just roughly to add those up in the chat real quick, can everybody just throw in a number of what you think you send out every single month to somebody else's bank on debts? I'm just curious. 5,000, Susan said. 6,000, 1826, look, 35,000, 12,500, 10,000, 10,000, 4,200, 2,300, 4,000, 3,000, 1,200, 4,600, 25. I mean, yeah. So, a lot of $4,000 to $5,000 ranges. Now, 105,000 for business. Listen, and here's the other thing I want to say is this would work for business as well. It doesn't just have to be your personal debts. This could be business. A lot of people have business debts, equipment loans, they have line of credits for their businesses, all that. So this works for all of it. So you guys all just saw those numbers. Now imagine if that number you wrote there wasn't a check that you wrote to somebody else. It was a check you put away for your future. It was your savings. Like, think about that. What would your life be like if all those numbers you just put up there were the amount that you were able to save, invest, use to enjoy your life, all of that money? Would that change your lives? Well, this is kind of like, it's a pipe dream for a lot of people. Like, yeah, it would, but, they always say, but I can't do that. Well, one of the things that I can tell you is that you can do that. I guarantee you. It might take a little bit of time, but we're actually going to look at a scenario with somebody that had $80,939 in debts. Okay, we're just going to look at four different debts, and we're going to show you how that one worked. And then this software, when we finally roll it out, which might be sometime fourth quarter, we'll be able to do this for everybody. You'd be able to literally say, okay, well, what scenario works best for my situation? Because everybody thinks they're a special snowflake, right? We all think, nope, my situation is completely different than everybody else's. Mine is different. We all do, myself included, Stephen included in that. But what this will do is literally give you three options for every scenario. Should I pay off my car? Since my car is 2.3% interest, doesn't seem like I should pay that off using my policy when my policy loan is 5%. Guess what? No more guesswork. The software will figure that out for you. And Ignat, I'm glad he's on here listening, because Ignat is the one who's developing the next round of what you will all come to love for Private Money Club. And once we get the initial preliminary stuff done for, what we're doing for what's going to be called the Blueprint team, the software that Craig's working on, that then we'll go over to Ignat, and he can then kind of make it work for an app and a bunch of stuff. Like, we're onto some big stuff here, folks. And I'm so excited that all of you get to be part of this and get to see this stuff literally unfold firsthand right in front of your face. Before I get into this, because I could just dive into the numbers, and maybe I should, but let me ask everybody on here, who's here for the very first time? Put I in the chat. We got any first timers? We got Heather first time. We always have 20 or 30. Dan, you got Charles, Rose, Corey. Oh, they're coming in fast. But anyway, any of you that are here for the first time, thank you for joining us. Tim's here for the first time. Thanks for joining us. What we're going to talk about is a concept, okay, a process that you all can use. It's not restrictive to anybody. It's not like this is a process only for the wealthy, like some want to believe. It's a process that's been used literally by the research we've done for over 200 years. So this is nothing new, folks. This has been around for a long time. It's something that technically should be taught in schools. It should be taught to every financial advisor, but it is not, because there's no money in it. It's a simple thing. Like, it's always been reserved for the wealthy because they were the ones that were privy to the information, the knowledge, because that's all this is. It's just learning something new. And the product that runs the process is one you all probably know of, but probably most of you don't like it. It's called a whole life insurance policy. When I say whole life insurance, some of you are like, oh, that's the worst place you could ever put your money. Yep, Dave Ramsey said that's the worst place I could ever put my money. But what if I told you that we're not talking about a regular whole life? We're not talking about the whole life Dave Ramsey's talking about. We're talking about one that is literally designed and engineered to do something totally different. Would that change your perception on what you think about whole life? Some of you are like, well, maybe. And some of you are like, nope, whole life's garbage. I would never put my money into that. All right, so I always like to open this up and start with this one point, because I thought the same way you did. I was an advisor for 16 years. We had whole life. We could sell whole life. Steven, same thing. He was a financial advisor. We both could sell whole life, but we rarely ever did. You know what we sold? Term insurance. Why? It was cheap. And then what did we have people do? Invest the money with us. And what never seemed to work? The strategy of buy term because it's cheap and invest the difference, so that someday later the amount that you invested and saved would equal the amount of the death benefit, so you'd self-insure. Guess how many times I've seen that actually work? Zero. Why? Well, because most people put the money into the investments when the markets go down, which they're going to soon. I just can't tell you when. When the markets go down, people get scared, they sell it, and then they blow it. Or an unforeseen event happens and they need to take the money and they need to use it. And then all of a sudden, it's blown. And then you know what happens when that person turns 50, 60, or 70 years old, when they really are thinking about, wow, I really need to make sure that if something ever should happen to me, my family's taken care of. And then their term insurance that they bought way back when ends, and they need to buy new life insurance, but it's like quadruple the price. They're like, dang, that buy term invest the difference maybe wasn't the best strategy, but then it's too late. So why whole life? This is a question we get all the time. Now, let me ask you a question. Forget about whole life for a second. Now, what would be the perfect place where you could put your money? So let's just start with a bank account. People put a lot of money in bank accounts. And why do they put money in bank accounts? Well, because it's liquid, I got checks, I can get my money. Sometimes you can't, but for the most part you can. It's got that FDIC thingamajigger that guarantees up to $250,000. I mean, there's a lot of reasons. But what would make a checking account way better? Imagine if I knew of a checking account. Imagine if I knew, let's use a savings account actually, because it's easier. Let's say I knew of a savings account with this special institution that it offered them. Not available to everybody in the public, but this special savings account had a couple cool things. Number one, it guaranteed you an interest rate. Let's just use 3.75%. You get guaranteed 3.75. But when I say guaranteed, I don't mean like bank lingo guarantee where it's guaranteed today and tomorrow if the Fed drops rates, it goes down. I mean guaranteed at 3.75% for the rest of your life. Never can change. You guys love that institution savings account, right? But then every year, this institution, what they actually did is they shared in the profits and they gave you a dividend every year. And with the dividend plus the interest, you were earning over 5 to 5.5%. That's even better than 3.75, right? 3.75 is guaranteed for the rest of your life. And then the dividend, not guaranteed, but you know, every year this institution's paid it since the day they opened their doors. Not too bad. But then let's just say all the interest and dividends you earned in this special savings account that I know about was tax-free. You know, you'd like that, wouldn't you? You put all this money in this thing, and as it grows and compounds, you don't have to pay any taxes on the money. That'd be pretty sweet. And then if you ever got sued, you know, you own a rental, somebody slips and falls out front, they sue you. They can't take the money in most states in this special savings account. Well, that's not too bad either. But then let's just say this institution had a special provision that, you know, only certain people could get, and it was only available to people that really understood. And that provision said that the money that's sitting in that savings account, you can use that money, but you don't have to take the money out of your account. So let's say you save up 100 grand in this special savings account, but if you needed 100 grand to lend to Stephen here, because Stephen was willing to pay you 12% on Private Money Club, you could take the 100 grand and you could lend it to Stephen, but your account still had 100 grand earning that interest guaranteed. Let's just say 375%, plus the dividend. Now that would be like that'd be like the cat's meow, right? You'd be like, shoot, man, that's too good to be true. And then, you know, the bank, you know, the special institution, what they basically said is they said, hey, you can use your money anytime you want. You don't even need to take it out. We'll just use your money as collateral, and we'll just give you, you know, the institution's money. We'll let you borrow that money, and we'll let you borrow it at a lower interest rate than what we pay you, so that every year you make a spread, kind of like how you make how a bank makes a spread on the money you give them. They pay you 1 to 3. They charge you 6, 7, 8, 9, 10%. You know, so they make a spread. But now this institution allows you to do that same thing. So, like, how many of you would want that account, that special savings account at that institution that I know about? It's guaranteed interest for the rest of your life, pays a dividend, grows tax-free, protected against judgments and liens, allows you to use the money anytime without actually taking your money out, so it compounds. Like, come on, how many of you would just stand in line to get one of those things if I told you what it was? Because I'm pretty sure if any of you are listening, every one of you would want one of those. But then what if I said, okay, it's available to all of you, and it's available to your friends and your coworkers and your kids and your parents. Everybody could get one of these accounts, except for that institution is not a bank. That institution is not a Wall Street firm. That institution is a giant mutually owned insurance company. And then that special savings account that I mentioned, you know what that is? That's a specially designed whole life insurance policy. Now, does anyone not want that just because I told you what it is? I bet you there's someone on here that's like, oh, well, now you put it like that. Yeah, I don't want that. See, that's silly, isn't it? You see, a lot of times what we want is right in front of our face, but because we have a misconceived perception of what it is and how it works, we think we know what we don't know. So now that we got the hard part out of the way, that's why we use the specially designed whole life. It does all those things. Plus, it pays a death benefit someday should you die. But again, it's not a regular whole life. We design these things to do something very different. We design them to be used as a private banking system. So they're literally designed upside down and backwards. And to design them the way we do requires us to get paid significantly less on those. That's why your advisor doesn't want to do this. That's why your advisor probably doesn't know about this. The institution they work for, the firm they work for, doesn't want you to know about this as an advisor, because they don't want you to make 60 to 90% less, because they know factually you won't make it very long as an advisor if that's what happens. So yeah, webinar is like, I want one. It's kind of like that movie, right? One Crazy Summer. Remember? Everybody wants them, with the little hamburger cartoon playing the guitar at the fast food joint. Remember that movie? Some of you are too young to remember that. Let me try that one more time. I want my $2. How many of you remember that one? Where's my $2? Well, here's the cool thing. We've got actually a shirt. So shameless plug here really quick. We came up with a very special shirt that I wanted to show you real quick. This is a limited edition shirt. We just came out with them. And there it is. Take back control of your money. I want my $2. You guys remember that one? And then here's the other one. Everybody wants some. So limited edition shirts, shameless plug. You can get them at chrisnaugle.com as soon as Shauna gets them up on there. All right, back at it. Let me show you something, because some of you are still not convinced that they would want to put their savings into a specially designed whole life. Well, let me show you a scenario of why mathematically it makes sense. So I'm literally just going to knock all the barriers down right here, because this is what we're working on. But this is just kind of a really rough showing of what we're going to create and what Akenot's going to help us create. This is a real example. I can't give you the person's name, but a 35-year-old male. Okay, and you can see they were going to put $10,000 of their savings every year was going to go into this specially designed whole life. And this 30/70 piece up here, this is just how we're designing it. So it's 70% to the paid up additions rider, 30% to the base. That's when I say specially designed and engineered. That's just kind of how we build it. There's a YouTube video that somebody can put up in the chat that shows you what that means and how it works. But here was his scenario, a real life scenario. He had a Visa, an Amex, a car payment, or a car loan, I should say, and a bunch of medical debt. Now, how many of you know somebody that's got medical debt? That seems to be a real thing these days. Oh, does everybody know that this is the last month before you have to start making your student loan payments back? I didn't mean to rub salt in the wound, but you do know that, right? Next month, you have to start making your student loan payments. Sorry, I didn't mean to get this off on a bad start, but that's the fact. So, you know, a lot of people, when they're thinking of their debts, don't forget to include that student loan debt that you've kind of forgotten about, because since 2020, you haven't had to make a payment on it. It's been deferred. Well, not anymore. Unless you're one of the fortunate ones, which I don't know who the fortunate ones are, that Mr. Biden somehow erased all of your student loan debt. I'm not even going to go down that rabbit hole, but here's the real scenario. $80,939 in debts, totaling monthly payments of $3,228 a month. This is very similar to the numbers you guys were just throwing out, which is why I asked. I asked how much money you pay every month for the debts. Right in line. Like we saw 3, 4, we saw 25, we saw, I think one was 100,000 or something like that. I don't know. Anyway, your debts. So $1,200 for the Visa. The Amex is $1,100. Now the $1,200 they're making on the Visa, you know where that is? That was this person making extra payments trying to pay off the Visa. Why? Because they don't like giving Visa 21% interest. And they were doing the same thing, $1,100 a month going to Amex, because Amex is one of those unique cards that if you don't pay it off after 30 days, they really put you through the ringer. I'm surprised that this person was only paying 23%, because Amex, I know, is 29.99% if you don't pay that balance off, at least on the cards that I have. So they were like, I got to pay this off. They're paying $1,100 a month. Their car payment, not too shabby, but at 7.8%, $578 a month, probably very similar to a lot of your car payments or lease payments. And then the medical expense. Now, most medical expense is 0%, because obviously it's, you know, it's medical. So $350 a month, $3,228. So here's what the software does. The software allows us to run 3 different examples. So let's just say this person just continues to do exactly what they were doing. So we're going to look at option number 1. Stay on the current pay down schedule, make extra payments here, and then these are just scheduled payments. So let's just stay on that and keep doing everything exactly the same as this person's doing. Okay, so let's run that scenario. How long would it take? 51 months. So we got 51 months to pay that debt off. Check. Total payments made, $105,000. So they owe 80, but if they take 51 months, doing what they're doing here, which is kudos to them, they're making extra payments, $105,692, so $80,000 plus 25, almost $25,000 in interest, right there, $24,753 in interest. Okay, not bad. So a lot of people wouldn't even look for another option. They would just be like, well, this is just what it is. I got to just pay this thing down. I'm gonna do my very best to just make extra payments, be a good debt holder, and pay these debts off. Fair enough. 51 months, and it's going to cost you $105,000 total. That will leave your family forever, and $24,000 of that money is all interest. So let's say they go to Dave Ramsey. They go through the school of Dave Ramsey learning, or whatever you want to call it, and they do what's called the snowball. Okay, no IBC, just Dave Ramsey. Okay, they're going to snowball the debt. Which all that would mean is you would put the lowest balance first. So this would be number 1. Okay, this would be number 2. This one would be number 3. And this one would be number 4. So all we're doing is we're snowballing. We're putting debts in order from lowest balance to highest. And then every time one debt pays off, so once we pay this one off, this $1,200 snowballs and goes to pay off the next one and the next one. Okay, sorry. I'm trying to draw numbers here with a mouse. That's the snowball. So how would that work? Now, it's definitely going to work because Dave Ramsey teaches it, right? And Dave Ramsey's genius. Dave Ramsey knows everything about paying off debt. Okay, he is pretty smart in debts. So in doing this, you go from 51 months to 31 months. Holy crap, Dave, dude, Dave is the man. Look at this, Dave. Just by doing what Dave Ramsey teaches, you just knocked off 20 months. 20 months. And all you did is put these in order from lowest balance to highest and took the payments from each one when you paid it off and rolled it into the next one. You don't work any harder or any longer, take on any more risk. You just change the order in how you do it. Total payments made, you would save about $5,000. Okay, so $99,514. And your total interest paid wouldn't be $24,000, it'd only be $18,000. How many of you would consider that a win? Don't be shy. That's a win, right? Well, it's a win over option one. And when you put it that way, yeah, it's a win. It really is. I mean, it's better. So then let's just say all we do is we add one piece, we change one thing. And that's where the savings goes first, where our money goes first, and we just do everything the same. So instead of putting it in a regular bank account or an envelope like Dave Ramsey teaches, we put it into one of these stupid specially designed whole life policies. And then we use the infinite banking concept, which is the process of taking back the banking functions in your life. So realistically, like to sum up option three, all we're really doing here is we're adding uninterrupted compound interest to the mix. That's really all we're doing. We're just allowing all of the money that you would use to pay these debts down to earn interest for the rest of your life, or in this scenario, just for the period of time paying down debt. Fair enough? That's really all we're doing. And the only place that you can do that, that I know of, and if somebody else knows of another place that does everything that I just mentioned, I would then change all my presentations to talk about this new vehicle that you know about, if it does what a specially designed whole life can do and does it better. Fair enough? So here, we just put the money into a whole life first. So then what happens? Well, we save 1 month. Some of you are like, well, that's not even worth it. Okay, you save 1 month, about a couple $1,000. So instead of paying $99,000 in Dave Ramsey's model, we pay $95,000. Instead of paying $18,000 in interest, we pay $15,000. So again, if we're really counting wins, that's a win. It's money in your pocket, not in their pocket. And all we did is changed one thing, and that was where the money went, and added one step, which is the infinite banking concept. But our team does all that for you. We run your banking system on the back end using our mapping team, and pretty soon using another team called the Blueprint team, but that's not out yet, coming to a theater near you. But here, look what else you get with this one. Remember all that money that we were putting away into that policy? Yeah, you've got $21,000 in cash value. Well, wait a second, you didn't have any money left over in these ones. You just had saved interest and no debt. But here you got $21,000, 21 grand. And not only that, after taking all the money out, because the scenario, the software accounts everything. It accounts for the cost of the loan. It accounts for dividends. It accounts for the cost of the life insurance, the death benefit. It accounts for the policy service fees. We're not missing anything. We're literally taking numbers right off of the insurance company's illustration and plugging them into a software that then calculates everything to the T. And we've been back testing it and back testing it and back testing it, trying to break it, trying to make sure that our numbers are right and we're not wrong, and they are. But you get a death benefit of $400. So in this one, did anyone get a death benefit or extra cash value? Nope. So that one wasn't a good option. In Dave Ramsey's, did you get a cash value that earns interest and a death benefit? Nope. And in this one, did you? Yep. So what did we change here? The only difference that we did was the option 3, and the software did all the math. Option 3 literally just changed where the money went first. So for the first time, I mean, conceptually, we could always do this, and manually, we could always do this. But now for the first time, we can literally show you this mathematically so you can make an accurate decision. Oh, I don't think that'll work for my scenario. Let's let math prove that, because I'm not going to tell you I think it will work. Steven's not going to tell you I think it will work. Let's just mathematically show you if it does or does not work. And folks, I'm just showing you debt, but what if this software could do it for your real estate deals? You know, you're thinking about, oh, should I pay off my mortgages on my real estate deals, even though the mortgages are 3%? Let's mathematically calculate it. Well, should I lend the money out, and how should I do it? Should I invest in this? Should I do that? Should I use it to buy this car, even though I could get a loan from the car company at 3% when it's going to cost me 5% to borrow from the insurance company? Mathematically, we can do all of that. So here you go. So key benefits of using the infinite banking concept, the process that we're talking about to pay off debt. you avoid paying an additional $9,651 in interest payments to a third party, okay? And that money will be gone forever if you continue to pay it the way you are today, okay? The debt payoff time goes from 51 months to 30 months. So 51 months, the way that they're doing it now, and you now have 30 months, and it pays all your debt off. You didn't save any more money. That's the thing I want to preface here. You didn't save any more money. You didn't take on any risk, and you didn't work any harder for this. This is the same dollars and cents. Nothing changed except for where the money went first. After paying all the debts in full, you're going to have approximately $21,421 in cash value to use again. Wait a second. I pay off all my debt in 30 months instead of 51 months. I save interest. I pay less money to someone else, and I got 21 grand. Yep, that's kind of like the sprinkles at the ice cream place. You're like, do you want, they ask you, they always ask, hey, do you want the sprinkles and whipped cream? And you're kind of like, I shouldn't do this. But yeah, give me the sprinkles. Okay, that's kind of what that's like. Oh, and also, if something should ever happen to you after you paid off all your debts, well, $401,000 would go to your beneficiaries, which are probably your kids and your spouse. So after paying all your debts in full, you have $3,228 of extra cash flow. Remember all the money you were giving away that you can do anything you want with now. You can go to Disneyland, you can go on vacations, you can invest that, you can start up another policy for your kids and your spouse. Heck, why wouldn't you? And after paying all your debts in full, you got $80,939 of debt out of your life. So this is the very first time that we literally have a software that can show you that. So the reason I wanted to do that scenario first is, just like you saw earlier, there's a lot of people that have debts. And a lot of people are looking at the infinite banking concept. They're trying to say, okay, does this work for me? Should I use this? I don't know. This guy said that's stupid. This other guy said that's the dumbest thing I've ever heard. You should never put your money in a whole life. Your financial advisor said that's terrible advice. That Chris guy doesn't know what he's talking about. You hear all this stuff and you're like, oh gosh, I don't know. I don't know if I should do this. Well, have your accountant, have your financial advisor run the math and come up with a better scenario than what I just showed you mathematically. Forget about people's opinion. We no longer need people's opinions. I don't need to hear what Stephen thinks is best for you. I don't care what Jimmy John says is the best thing for you. I don't care what your advisor says it's best for you. I care what math shows is best for you, because the one thing that's certain about math, and any mathematician will say this, is it doesn't lie. People lie all the time. Or people make assumptions all the time, or people, make hypothetical statements all the time. I'm probably guilty of some of them. But when you do the math and it works, there's no reason or no way you can not understand that that's just mathematics. So let's hit some of the questions, and I want to take that scenario, and then what I want to do is I want to do a continuation, because we always show one thing or another, but now what I want to do is, now that you just saw, and all of you put a number in there, right? When I asked you how much money leaves your family for debt payments, you all put a number. I just want you to now put yourself in the shoes of this person. 30 months from today, all your debts are gone, and now all that extra income is back into your checking account. And then what's next? So now what we're going to do is, from there, after I answer some questions, we're going to go to the next step. And what would you do then? And we're going to do a couple scenarios there. So Stephen, what questions can we hit on that last one?
Yeah, a lot of stuff coming through the chat box. I just want to miss it. So guys, make sure you put your questions in the Q&A box, and we'll make sure to hit all of those, as we go here. So you just want me to kind of go through them real fast? I haven't read them yet.
Yeah, let's just hit them, and then we'll just knock them
okay,
out
so how do you credit your account when the borrowed money was the insurance company's capital, not your cash balance funds?
How do you credit your account when the borrowed money was the insurance company's capital? Well, I just showed that. So just like the snowball effect, right? So, for that person asking that question, it's no different than the snowball. When you pay off Visa or Amex, or here, let me put it back up on the screen so that we're all looking at the same thing. When you pay off any of these debts, what's essentially happening is we are literally taking whatever the payment was here, okay, the $1,200, and we're rolling that into the next debt, and the next debt, and the next debt. So how I do mine, and Brent Kessler and myself do it a little different. Once I paid this off, the $1,200 that I used to give to Visa, because that's a fact. You're paying, this person was paying Visa $1,200 every month. But now what I did is, over here, I added a whole life policy. I took a loan from the whole life policy, and that loan cost me 5%. It's actually a little bit less, but I'm just kind of giving you the benefit of the doubt. So that's simple interest. So simple interest, sorry, tough to do with the mouse here. So I took the loan from the whole life. and I paid off Visa. So Visa's paid off. I take the $1,200 I used to give to Visa, and I use that every month to pay down the loan. And then when I get enough money in there to pay the next loan off right here, let's say I want to pay off the medical. Now, a lot of people would look at this, and this will defy what your mind will tell you to do. So you got to be careful here. So in this scenario, we go lowest to highest. That's the snowball. People would not want to pay off the medical. Why? Because it's 0%. They're like, why would I pay the medical off when it's 0%, with money that's going to cost me 5, right? That's what you're thinking. Don't think, trust math. Don't think, trust math. Where was Duck's comment? There's little lies, medium lies, and big lies, or however he said that. Just trust the math. So we pay off the medical, even though it's 0%. We no longer owe that. We take the $350 a month we paid to the medical debt, and we paid that back to the policy as a loan repayment. So remember, if we started with 10 grand, and I'm just using this, how much interest and dividends is 10 grand earning when you paid off Visa? If you had 10 grand, you took 10 grand out to pay Visa off. How much do you have earning? All of it. And then when you took the 10 grand out, they're charging you 5, but aren't you making more than 5? Indeed you are. Okay. The only years this doesn't pencil, and we show you, I could break it down to you as much as you want. Usually the first 3 years, you're running a negative deficit. Okay. But after that, it's a positive tailwind for the rest of your life. You constantly will make money, a spread, after the 3rd year for the rest of your life. Some of you, depending on age and health, might be the 2nd year. But then after you do that, now we got $1,200 plus $350 coming back, paying the loan down to the insurance company, and we just repeat the process. So the next one we paid off would be the car. When we saved up enough in the policy to pay the car off, we take a loan for $24,000. We take the $578, we pay it back to the policy. So this isn't complicated. This is what Dave Ramsey teaches every day. But instead of putting money back in the policy, you put it in an envelope. Now, correct me if I'm wrong, because I could be. Does Dave Ramsey have a special envelope that pays you uninterrupted compound interest? Just checking. Does Dave Ramsey have one of those? Does the envelope Dave Ramsey uses and gives to his clients, does that envelope have a magical thing inside that pays you uninterrupted compound interest? I don't know. Maybe, but I don't think so. This envelope, where we put the money, called a specially designed whole life as a loan repayment, does pay you uninterrupted compound interest. So it's a really special envelope. Yeah, Rick said no, he doesn't. And then after that, you pay off Amex, which is the biggest. You take $1,100 and you put that money back. So now all this money, $3,200 a month, is money that was leaving your family forever. Now that money's coming back over here. So as soon as we pay the policy, and we typically don't wait to pay the policy back, but let's just hypothetically assume $3,200 every month. Let's figure this out. $3,228 times 12. Whoops. 3,228 times 12. That's $38,736. $38,736 a year. Okay, if we multiply this times 12, okay, that gets you 38. So at 38,000 times 3, 38,736 times 2. So in almost a little bit more, like 2 years and like 1 month, in 2 years and 1 month, if you just kept these payments you were giving to these companies, if you just kept that 3228 going back to your policy, you would pay back the loan to the policy, which would mean you'd have $80,939 to use the next day, plus any of the interest that compounded and the dividends that compounded. So it'd be way more than $80,000. You kind of see what I'm saying here? So your question makes sense, but it doesn't really hit the real thing that we're just doing. But I just showed that just so you could see it again. All right, what else we got, Stephen?
All right, cool. So somebody that already has a policy, other than paying back the policy loans, if they get a windfall of profit or a bonus, how can they add that to the policy? Can they buy additional PUAs? Or the policy loan is working, now I have additional money, I want to run through the policy. So
yeah, so unfortunately, Edgardo, if you have a policy and you're maxing that policy out, and then you get a big profit or a bonus, you can't put that money back into the existing policy. You could pay back the loan to the policy, but you can't put that money into the policy because we build the policies right to the IRS limit, the max 7-pay limit. So it's rare you'd ever have enough room in any policy we designed for you to hold extra money like that. So you're going to start your second branch office. You would take that extra bonus and you would do another policy. I just did my 10th policy. Why did I do my 10th policy? Well, because I did the math And in my segregated bank account, which is just a separate bank account that I use to track all of my infinite banking activity in and out, there was roughly probably about $3,500 extra every month that I couldn't put into any of my policies. So what I did is I set up a new policy with Guardian, and I did Guardian because I live in New York and I already have an SML policy, a security mutual life policy. Cash wanted all of you to see him. So what I did is I said, all right, I'm gonna start another policy for $2,000 a month, because I know there's an excess of at least $2,000 a month going into that separate bank account, and that's going to be used to fund the policy. Again, can anyone tell me that $2,000 extra in that separate account, is that extra money that I had to go out and work for? Is that like coming from my W-2 income, from my salary? Is that coming from my bonuses? No, that's coming from my money working for me. My money's out there working in loans. I still have lots of recaptures, about 50, oh, actually it's more. I think it's close to $6,000 a month in money that comes back into that separate account, which used to be money that I paid for car payments, used to be money I paid for visas and lines of credit. See, it's not new money. It's just money I used to give away and now I keep it. So that's the money I use to fund separate policies.
All right. Oh, sorry. Are you paying off the debt on a month-to-month protocol? I need a step-by-step how am I doing this from my policy, my bank to the creditors?
Yeah, that's a great question. So that's something our mapping team would help do. So like usually on a debt payoff scenario, like what you saw, it's usually going to be a quarterly basis because, month by month, you're not going to have enough money built back up because it's just 1 month. So usually on a quarterly basis, we'll make the payments down toward the debts. But our team, you wouldn't have to do that. Our team does all that for you. And then we've got a new program called D4 or Blueprint. We haven't determined what name it's going to be. Excuse me. I think it's going to be Blueprint. That team would actually do everything for you and literally just walk you through and hold your hand and pretty much do everything. That's why it's called Done For You.
How about combining this with velocity banking?
Yeah, well, stay tuned because you're going to be seeing a lot more of that. So velocity banking, using the velocity of money, is something that works with the infinite banking concept. Everything you just saw is using velocity banking. If you know velocity banking, maybe you follow the YouTube channel Vantastic or Christy Van. She does a great job of teaching velocity banking. Everything that she's using with money, outside of, they don't use the whole life policy, but they certainly use the velocity that I just showed you of taking the payments you used to give away and using that velocity back into your own system. And it can be used many different ways. We're just using a spread in a whole life policy versus using a spread in a HELOC or a spread in a credit card. So the two work hand in foot, but really where the fit comes for velocity banking and infinite banking is velocity banking works really well for people that can't save money yet. Maybe they're living paycheck to paycheck. They've got lots of debt, and every dollar they have, like that scenario I gave you, every dollar they have is going to pay off their debt. So until they get to a point where they can actually save money and put that savings into the specially designed whole life, then IBC wouldn't work for them. Velocity banking would. So there's a convergence point where velocity banking yields or makes way for infinite banking. So that convergence is what we're really embarking on right now with Christy to find out what is the best place where IBC comes in to complement velocity banking and where do the two really work hand in foot. Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
All right. If you borrow from a policy, does the money borrowed still grow at the same rate or a lower rate?
Same rate. But Heather, that's a good question because not every mutually owned insurance company is the same. So write this down. It has to be a non-direct recognition. Okay. So there's two different types of schools of thought or ways that they do this. There's direct and non-direct. So it's just in the name. Non-direct means that it does not recognize the loan. So when you take a loan from the policy, the ones that we use, they don't recognize the loan. So therefore, it doesn't interrupt any of the interest. Your interest rate doesn't go down. But a direct recognition company, I'll use, like Guardian is direct recognition. It's a bunch of them. There's more direct than there is not. But anyway, direct recognition would recognize the loan. So when you take the loan, it reduces the amount of interest and dividends you're getting because you're working off of a lower balance. So we prefer to only use non-direct recognition companies. The only way we'll use direct recognition, like how I just bought a Guardian policy, but I have a cash value line of credit. All of my policies, all 10 of them feed into a cash value line of credit. So I'm not borrowing direct from the insurance company. I'm borrowing from a line of credit that is collateralized by the insurance companies. But I wouldn't say that makes sense for anyone at this present point where interest rates are.
Wouldn't it be more beneficial if I paid off the debt that has the highest monthly payment but lower balance to recapture that cash?
Again, so this is where your mind wants to trick you, webinar attendee. So webinar attendee is saying, wouldn't it just make more sense? Because your mind says pay off the higher balance. But folks, listen, trust the math. The math is what we played into here. This is what we looked at. It right here. So your scenario, wouldn't it make sense to pay off the higher balances or the higher interest rates first? That's what this person was doing. That's option one. So it's going to take you 51 months. 51 months versus not paying off the higher balance or the higher interest rate and then putting them in the lowest balance to highest balance, the snowball. Then right here, you go from 51 months to 31 months. So don't allow your mind to trick you. Allow math to lead you. This is math. This is not our opinion. So the answer is no. Doing it the way you just suggested, although your mind tells you to go that way, math proves it wrong. And it is because of the velocity of how money works. By paying off the lowest balance, you have money available sooner because it's a lower balance to then work in the velocity, work in your favor and come back to help pay off future debts. I got to throw a caveat in there. Our software is so good that literally, if there's a way where we can basically take what you just said and it does make a difference, we have a way to actually do that. So let's just say it's an oddball scenario where there's only a couple debts and one is way out of whack, right? But it's a higher balance. We can actually go in and run a scenario where we actually just manipulate it and say, all right, what if we just paid this one off? Does it work better? So the software allows you to go in and actually do what you just said and prove, does it work faster or not? Because Snowball doesn't always work 100% of the time. In this scenario, it did, but the software will allow you to prove that mathematically.
Explain how the insurance company makes money if you take a policy loan and you're paying 5% and earning 6% on the interest and dividends. How's the insurance company making money?
Because the insurance company takes all of the money in their general account, which in some cases is hundreds of billions, and invests that money for the long term, and usually long-term treasuries, private loans. So like if you've ever driven around your downtown, wherever you're from, Dan, like you probably see a bunch of skyscrapers. And if you were to actually go in and look at who the lien holder on those skyscrapers are, what you would find many of the times is it's an insurance company. So insurance companies take the money in their general account and they invest that money. They lend that money in first lien positions. They buy treasury bonds. And right now, treasury bonds are probably, it depends on which ones they're buying, 5.5%. So they're locked into an interest rate on all their money. And on an average, their interest rate they're earning on the money is higher. Plus, the insurance company charges you 5%. So the 6% that they're paying you it's a number that I know what you're trying to do. You're trying to rationalize, like, how could that make sense? They're paying you more than what they're making, but their money is working for them. That's the thing. Like, you want to think that you have to work for money because that's what you've been taught your whole life. Insurance companies for hundreds of years have had money working for them. So the money working for them is at a higher velocity, a higher rate than what they're paying you. If they're paying you 6, they're probably making 7, 7.5. Okay, so the money's already working. They're making a spread there. And then on the policies, they're charging you for the cost of insurance, and they're charging you a policy service fee, and then you're paying them interest on the money at 5%. Remember, the 6% is the derivative of their money working for them. It's not whether or not they're making or losing. The money's just earning more than what they're paying you. They would never pay you more than what they're earning on the money. And that's a reflection of the dividends, which is very unique because we're in an interesting cycle right now, a higher interest rate cycle. So mark my words, watch carefully. Over the next couple of years, dividends from insurance companies are likely going to go up. We've already seen the trend. We've already seen a couple of the companies raise dividends. The rest of them will get in line and you'll start seeing interest rates raised for the next couple of years. And that's because they're making more money on their money working for them. Hopefully that makes sense, Dan.
Guy was just saying, then why not start with the car loan since the medical, was a no interest loan? And one thing, guys, there's different ways to run these debt pay downs, and the calculator will give you the ability to do that, run different scenarios, balances first, and good.
Who was saying that though?
Guy, Lush Pell.
Guy, again, just let the math do the work for you. Like you're trying to rationalize like that you're smarter than math. And I'm not saying, you know, that's what you're trying to do. You're just in your mind. I know what you're trying to do. You're trying to rationalize. And I said that when I was given that example, like your mind will want you to pay off the higher interest rate ones, because that just logically makes the most sense. But mathematically, that does not always make sense. You can run all the different scenarios. And there's lots of you that are like, you know, data people, maybe you're the engineers types where you just got to run every scenario. The software will allow you to run any scenario you want. But mathematically and statistically, the snowball that I showed you will work probably 9 out of 10 times better than what you're trying to do. But guy, like you can run it yourself, do the math. And if you can beat what I showed you there, great. Then you would know that your scenario is right. But it's the velocity that you're not understanding. And you're also not understanding that in the strategy with the whole life, all of your money that you put through the whole life, all the cash value is always earning interest and dividends, whether you take it out or not, whether you have it in there or whether you have it all loaned out to pay off debts, you're still earning all of the interest because these are non-direct recognition companies.
Who do you go through to get a whole life set up that way?
Oh, Stephen, do you know anybody? I don't know. I don't know who would ever give up 60 to 90% of their commission so that you could have 60 to 90% more money immediately in the first 30 days. Can you please give Shireen our team's contact info? Because that's exactly what we do, Shireen.
Yeah, it's funny because we do sometimes, like when Chris used to do the presentation, the full 90-minute one, you know, years ago, and we get to the end and people were like, oh, I'm going to talk to my agent. I'm scheduling here and there. I'm like, Chris, you forgot the most important part, to tell people this is what we do. Our team does this for you. So
every day,
not just educate, we actually will build this for you and have the experience to do it the right way and fit your specific situation. You know, every single person on here, there's 170 people, 160 some people on here right now. Every one of you is completely different. Your age, your health, your situation, your finances, your goals, your everything in life is different. So every one of you is going to have a different policy setup and structure and how it works. And so we need to set up a call with you to learn about that. And that's what that call is. So I post a link on there. I'll share it again in the chat box, but just know it's a free call and you're not going to be sold anything. Like we don't sell at all. We just are going to ask questions. We're going to answer your questions, and you're going to have to ask us to set it up, but we will set it up for you if it makes sense and if you want us to. So,
and the whole idea behind that is if you just teach people how to be a good steward of their money, if you teach people how to solve their problem, you don't have to sell them anything. They will ask you to help them. And that's what we do. And I learned that a long time ago. Give your best stuff away for free. If I can show you how to solve any of your money problems, do I need to sell you anything? Because once I show you how to solve your problem, let's say you're this person, and I just showed you literally how to pay all your debt off in 30 months, save whatever it was, how to save $10,000 in interest. I've solved your problem. Wouldn't you ask me, yeah, can you help me do that? Of course you would. That's how we do things.
And let me not leave it there too. Like we not only help you at the beginning, but through the entire process and for literally the rest of your life. So getting the approval and then getting started, setting up your online account and taking your first loan and creating that debt pay down map for you, or if you're using it for investing, how to move the money, or if you're trying to buy a Porsche, you know, how to recapture all the money. I mean, Chris, I know you just bought a Porsche. I don't know if you have a case study yet. Devin Burr, who we do a lot with. I mean, he just showed how he just bought a $150,000 Porsche and how he's going to make $130,000 over the next 5 years by buying that Porsche because he used his policy for it. So things like that. So we can show you exactly how to do all that too. And we don't charge for any of that. So we don't charge for the initial call, for the setup, for the help. You know, we make that small reduced commission from the insurance company, but then even years and years and years to come for the rest of your life, that's just part of being a money multiplier client. So,
and the other thing, like what Morgan just said, like, you know, we don't have any clients mad at us. That's the interesting thing. Like, you know, we have over 8,000 clients in the US alone, plus our Canadian partners up there. But, you know, out of 8,000 people, like nobody's mad at us. You know, like if you read Morgan's comment, you know, he set up a policy with us and it's working just like the illustration. Of course it does. It works exactly how we show you. Like there's not really a lot of moving parts. It's, you know, like today's cars, right? They got all these moving parts and all these things, and things break all the time. Old cars like had less moving parts, so less things broke. Or less things break. So it's the same scenario. That's a bad analogy, but you get the point.
All right. So Duck's saying his baby's 5 months old now. Do they have to wait till they're 6?
No, you can do it. I started Vivi's at 6 months old. But you certainly don't have to wait. And
Yeah, I mean, Drew's on. Drew, how old was your baby when you started?
yeah, there's Vivi's policy. So this is when I set it up. I mean, Vivi's policy I set up, it's a small policy, 5,000 a year going in. It pays for her college, pays for a wedding, pays for the down payment on her house, pays for her kids' college, her retirement at 90,000 tax free. So by the time she's 90, she's put in, between me and Larissa and her, we funded it at 398. She's taken loans of 2.73 million. She has cash value earning interest and dividends of 5.5 million. She didn't use 2.9 million of the cash value. It's just, she didn't use it. And she made a net return of cumulatively 738% over the course of the time. That's my daughter's policy. Who doesn't want to set one of those up for their kids? And if you don't, you selfish son of a bitch.
All right. So policy loan interest is simple annual interest. So each year it's calculated on outstanding loan amount, and each year it's paid to the insurance company, simple interest.
Yeah, and I think that's an important thing, because we do that in our presentation. We show you the difference between simple interest and compound interest. And we give an example. If you're paying 6% in simple interest, just follow with me, 6% you're paying and you're earning 4. So if you're paying 6 and you're earning 4, but the 6 is simple interest and the 4 is compound interest, are you losing money? If you're paying 6 and you're earning 4, are you losing money? Let's see it in the chat. Like, is it possible to make more earning 4 when you're paying 6? A bunch of you are saying no, but see, Drew said yes, because yes, it is possible. And it is possible to earn more when you're earning 4% and paying 6, because 6 simple versus 4 compounding, in a matter of time, the 4% compounding will make more than what you would pay on the 6% simple. We mathematically we have proven that, and we teach that all the time. But again, like, that's one of those weird things where you think you know what you don't know. You think you're like, wait, 6 minus 4 is -2. I'm losing 2%, but you're not factoring in the power of compound interest. And let alone compound interest in the whole life, it's uninterrupted compound interest. That's the magic. Your money's always working for you inside the whole life. It can't not work for you unless you set it up wrong, or do it with your broke-ass brother-in-law who builds it wrong, or do one of those direct recognition companies and you don't know the difference. So compound always beats simple mathematically. I'm saying mathematically too much today.
What's an SMS policy? I have no idea.
I have no idea. You might be referring to Security Mutual Life, SML. That's one of the carriers that we use here in New York. I'm not sure what SMS is.
Just closed out his cash value line of credit with Coastal, as it is not at 7.5. Guardian is at 5.8, Mass at 5,
yep,
and 5.5.
Yep. So what James is talking about is he like me had a CV line of credit, a cash value line of credit with Coastal States Bank. Recently, Coastal States Bank, and on your statement you get this thing that comes up where the rate changes. It went to 7.5%. Mine just did that. And then, Jimmy, how I'm doing it, because it's just too hard for me to unwind it. What I do is I jump from bank to bank, and I find a lower intro rate at another bank that will do a CV line of credit. I take that intro rate that they offer me, I bring it back to Coastal, and I say, can you match this? It's worked twice. I don't know if it'll work anymore, but if it doesn't, then I just jump and I move over to another one. But the way you did it, moving it back to the insurance company, is probably the smarter way. It's just a pain in the butt for me because I use my private banking system so much. Having a CV line of credit gives me one checking account that I can write checks out of and one place for money to come back to. So it's a convenience thing for me. So I'm actually willing to pay a little bit more for the convenience to the bank than I would to the insurance company. But for 99.9% of all the folks on here today, I would tell them, do not use a cash value line of credit right now.
The segregated account can work very similarly.
Very similar. Very similar.
Chris has a brain that he has to complete a circle on everything, so it makes it a little more complicated. But
I just like drawing circles. Sorry.
Yes.
Wheels on the bus go round and round, folks. Round and round.
That's the difference of barely getting by and being a multimillionaire. Just add a 0 or 2.
That's it.
Why would it make sense to do a HELOC if rates are at 9%? Well, my IBC policy only pays me 4%.
So Denise must be talking about why would it make sense to take a HELOC, take money out of the HELOC and put it into the policy when the HELOC's 9 and the policy pays me 4? It wouldn't make sense. So I don't know who would be telling you to do that. The only way it makes sense, Denise, is, and I'm just going to put this on the board because it's just easier for me to.
You got to add the infinite banking part of that there. You're not just taking the money, putting it in a policy. You're taking the money, putting it in a policy, and doing infinite banking with it, meaning you're then going to move that money into presumably an investment that's going to pay you, let's say, 15% annual. Right. And now you have the 15 plus the 4 against the 9. Now we're talking.
Yeah, so I would never tell somebody to take money from a HELOC and put it into a whole life ever. I actually think that's a terrible idea. Matter of fact, I do just the opposite. I take money directly from the HELOC and I lend that money out and I lend it to the Fullers or to Chris Root at 12%. Actually, I'm getting 13 with the Fullers right now. So I'm getting 13. So would you take money from the HELOC at 9 and lend it at 13? You would, right? So that's, yeah, that's a spread. That's 4% you make. So you just made 4% doing that. But if you move the money from the HELOC to the whole life, and then you lent that money out at 13%, would that still make sense? We'd have to run the math, but yes, because you're making 13 here. So you're still making the 4% spread, plus you're making the uninterrupted compound interest, which is the spread over here. So you really have to complete the circle. You would have to add the infinite banking concept in order for that scenario to pencil. Otherwise, do not do that. Ever.
Have a policy with us, JP does. Do you recommend paying back the loan? What happens if you're unable to pay back a loan?
Nothing happens. If you don't pay the loan back, just make sure you know to remember it's your bank. So you never want to steal from your bank. I've been in your scenario, JP. I had many years ago, 55 Newman Place was the property that me and my wife were renovating. I used my policies to fund all the renovations. That property was just, it took forever. It took years to finish that property. I couldn't pay a lick of the money back to my policy for a period of over 2 years. But when we sold the property, I paid my policy back with whatever interest I could, which wasn't as much as I was hoping. So the insurance company will never ask you for the loan back, but don't ever steal from your bank. Because as Nelson Nash would teach in Becoming Your Own Banker, you never want to steal the peas.
Can you show how a policy works without debt? Somebody that doesn't have debt, how they use it, how does the money flow, trying to figure out how to pay for daily life through a policy.
Okay, Katie, you would never want to use this to pay for your groceries, your diapers, your utility bills. It's just, I did a whole YouTube video. I don't know if somebody can find that YouTube video that I did on not using this to make your daily expenses. So Katie, what you got to understand here is everything that we're talking about here, this process is always about your money going out and working for you. So the reason that this system and this concept works, the infinite banking concept, is because your money gets to go out and work. If you put money into a policy and you took loans from the policy to buy groceries, is your money working for you? No, the only thing that's going to happen is the groceries are going to create, extra calories in your body that you then got to go work and run off. Bad scenario again, but again, don't put money in a policy to use it for daily expenses. So if you can't save money, like if you're at a point now where you're not able to save money, this concept, the infinite banking concept, should not be put into your life yet. That's why we're working with Christy.
Let me give you another scenario.
Yeah.
Let's say, pretend Katie already had a policy with, let's say, a couple $100,000 in it. What she's kind of asking is, how would she use that if she's not paying off debt? So she has all the money, she's saving money, she's putting it in there. Now, what does she do with it? So while you're drawing that, so yeah, you absolutely can use it for everyday expenses. It's just not the best way to do it. So what we'd probably want to do is take that money, put it into an investment, and then use that profit from that investment to pay for your everyday living. And that way, that passive income is now covering all of your bills. And once you get to a certain level, you no longer have to worry about it. So maybe that's what you're hopefully drawing there, Chris.
Yeah, it is. I mean, folks, this is the circle that we're always talking about. I keep things really freaking 3rd to 5th grade level. So we all can draw a circle. And on the circle, your money starts on the left side and it then goes over to the right side. The right side is an opportunity. Okay, the opportunity I showed you earlier was paying off debt. But in some scenarios, some of you don't have debt. Okay, which is what I was going to get to, but I've been answering a lot of questions. So let's say you had 100, and we'll use his example, 100 grand. So you take a $100,000 loan, that loan's going to cost you 5%. But over here in your policy, even after you took the loan, you still have 100,000 earning interest. And let's just pick, we'll use Lafayette's rate of 5.2 because that's one of the lowest that we use, 5.2. So you're making a spread. So I'm just going to give you a gross spread of 0.2% spread. At least it's positive. Okay, so just use that. So you're making money one time. the money goes out here and you lend it out through Private Money Club. Let's just say you lend it to Chris Rude's got a deal right now that he's raising for at 12%. Let's say you lent it to Chris Rude in first lien position. He pays you 12%. So every month he gives you $1,000 a month in interest. Then you take that $1,000 a month, and you know, some people would be like, all right, I get $1,000 a month, I'm going to put it in a checking account. So let's just draw a checking account here. This is just a segregated checking account. What I do, what Stephen was saying, is I take this $1,000 a month and I put it back into the policy every month. So then I'm paying the loan down, which means the insurance company is charging me less interest, or they're charging me the same interest, but on a lower declining balance. Where I always kind of argue my point of why do I always complete the circle, even though it's extra work, I'm picking up a nickel or a penny here and there because I'm paying the loan down, which means I'm paying the insurance company less interest when I'm still making more interest. So this is just the way to go. But let's just use this scenario. Let's say somebody was like, well, you know, that sounds good and great, but I need money to live. Great. You just made 12%. So let's just say out of this $1,000 a month every month that you're making, you put $500 a month back into the policy as a loan repayment. You take $500 a month of this newfound income and you use that to help your living expenses. So over here, this extra 500 is living expenses. You're in full control. Like how much you send back to the insurance company to pay down the loans is completely up to you. The insurance company doesn't mandate that at all. The insurance company is going to charge you 5% interest one time a year. So I always just tell people, complete the circle, never steal from your bank, which is this $500 that you're paying back to the policy.
I like it. I like it.
Yeah, these are great questions. Hopefully everybody's learning from these questions.
If commercial real estate crashes, how will that affect a policy?
I don't know. It won't. Ron's probably thinking, well, if the insurance companies have the buildings and the price of the buildings decline, like how does that affect the insurance company? It doesn't. I mean, they still own the property. They still have the lien on the property. They lent the money on the property. So if the value goes down, I mean, doesn't mean that the borrower can just walk on them. Doesn't mean if the insurance company actually buys the building, which in a lot of cases they own the buildings, they still have tenants, they have to pay rent. And if the tenants can't pay rent, they get evicted and new ones get brought in. I mean, commercial real estate dropping will hurt every business that's in the commercial real estate business, but only from an appreciation standpoint, which I agree, Ron, that's going to happen, but it's not going to affect the insurance companies. It might affect their balance sheet because the assets on their balance sheet are worth less, but that doesn't affect your dividends. It's not going to affect anything that you're doing.
Then with commercial backed loans out there in a market where commercial real estate in some cities is sitting more vacant than ever, are they at risk with that portion of their portfolio?
Yeah, they are, just like I was just mentioning a second ago. So, you know, a lot of these commercial backed loans, you know, or mortgage backed loans, they call them, MBLs. So a lot of these commercial loans, yes, they're having trouble. A lot of the buildings are vacant, which means less revenue, less money for the insurance companies, but the insurance companies have all the money. So is it going to hurt their bottom line profits? Possibly. I haven't seen it. I mean, we've seen their balance sheet and profit and loss. So for two of the companies, Lafayette and One America, we've seen them and they're looking pretty good, but they're incredibly conservative. And a lot of the buildings, they just lend on them. So the borrower still has to make the payments back to them, regardless of what their vacancy is or not. Because when I looked at their thing, yes, they own physical real estate, and that was a piece of the pie. I actually have it here. But the majority of the pie was treasury bonds, followed by first lien position bonds. So let's see, I'll give it to you here. So MBS, so mortgage-backed securities, was 15% of One America's. Mortgage loans was 15%, alternatives 3%, policy loans 2%, cash 1%, real estate less than 1%. So you can see they've backed off of the real estate. They have other at 6%, and then they have bonds of 58%. Usually those bonds are going to usually be, you know, AAA rated corporate bonds or possibly lots of treasury bonds. Again, I didn't have the breakdown. They did give that to us, but I didn't take a screenshot. So that puts it into perspective. So it's a very, you know, it's 15% exposure to the mortgage-backed securities.
Can I show this chart for LLC since 1990? Is that cool if I just share this?
Yeah, go ahead. Johnny's asking, is there a chart showing the last 10 years of dividends? Yeah, I have another one too.
So this is showing since 1990. This is just one of the companies we use, Lafayette Life Insurance Company, which is owned by Western and Southern Group, and just shows kind of, like Chris said, you know, as things like treasuries kind of have come down, because these companies invest a lot in that, you know, the dividends have come down. And as we're starting to see some of these rates come back up right now, these companies fully expect, the dividends to start to increase right along with that. And something to note real fast on dividends, just to kind of clarify a little bit. So a lot of people want to kind of look at an insurance company and say, well, the dividends are higher with this company compared to this company, so I want to go with the higher dividends. And just know that that's not always the case. So in the insurance industry, there's actually no standard for how dividend interest scales are calculated. So for example, Lafayette Life dividend scale interest rate is net of investment expenses and default costs, yet companies that we all are very familiar with that I won't mention, they may show gross numbers in their rates, showing an effective higher dividend scale, but in reality, the lower one might actually be benefiting you more. So it gets a little confusing. And that's why we don't like to just focus on dividend rates, not because it's not important, but because there's so much more to this process than chasing a quarter point on either side in the dividend rate from the insurance company, when the real power of this comes in through things like non-direct recognition, through the policy being designed properly from the beginning for the highest efficiency growth, to actually using the policy the right way for infinite banking and really being the most efficient with moving the money from the policy and mapping all that out. And that's where our mapping implementation team does such amazing work, because that's the most important aspect of all of this, is how you move that money, and they're right there to help you do that. And so just kind of keep that stuff in mind when you start wanting to go back to, but what about this in the policy, or what about these dividends? Just there's a reason we say it's not the most important part. Fair enough?
I'm glad you showed that. So Johnny, as you can see, like that goes back further than 10 years. I was searching my email trying to find an old one I had from Mass Mutual, but all the insurance companies, we've been on a downward trend for dividends, except for right now, we're starting to make that curve back up because we're in a rising interest rate cycle. So the past 10 years are going to be a declining, and then probably the next 10 years, I can't predict the future, but should be the other way and start climbing back up because of the rising interest rates. Thanks for having that, Stephen.
Let's see. The webinar attendee is Robert. Does paying off IRS debt take precedence in the snowball, as I think I heard Dave Ramsey once say?
Yeah, I would say if you owe the IRS, we probably should pay them off first, because I know, number one, they screw you left, right, and center on the interest that they charge you. So yes, that is one of the probably few exceptions to the snowball rule. You don't want to owe the IRS money.
When we pay ourselves back with interest, is the actual interest paid our percentage plus the simple interest that's charged by the mutual life company?
You pick and choose what your interest is. So let me give you a scenario. This is the easiest way for me to do this. So let's just say I want to buy a car. Okay. So we all have bought in cars before in our lives. So here, get rid of all this stuff. So we're going to do the same thing. I'm going to buy a car. How I would do this, and I do this all the time, we're going to be doing a whole training on how to buy cars. Like, it's going to be the most comprehensive car buying training we've ever done. So in this scenario, the first thing I would do before I buy the car is at the dealership or wherever I'm doing it, or maybe bankrate.com, I would figure out what is the monthly payment. Let's say I'm buying a $50,000. Actually, here, let me do the math because I know the numbers. $74,000 loan. Okay. And this is from a credit union at 7.75%, which is ridiculously low for interest rates for car loans. $74,775 for a 5-year loan is $1,500. I just had the credit union run this math for me because I wanted to know for a training. So how much money would I pay myself back? So let's say instead of using the credit union at 775, I take a loan for $74,000 from my policy. Can anyone tell me how much money I would pay my policy back? Stephen, what do you think?
74, $1,500 a month.
So if the credit union, this is the bank. So the bank would charge me 7.75% for a 5-year loan for 74 grand, and my payment would be $1,500. So if I wanted to borrow the money from my policy and buy the car, how much do you think I should pay my policy back?
$1,500 a month.
Right. And why would I pay myself back $1,500? Well, I don't know, because the bank's going to charge me $1,500. Why would I charge my bank any less? Or why would my bank charge me any less? So if I'm okay paying the bank 7.75% and $1,500, well, then I would pay myself back. So if the interest rate's 5% for me to borrow and the car loan would be 7.75, I just picked up 2.25% on this side. Okay. So And then I'm earning, we'll just use Lafayette again, 5.2% on this side. So I just made money twice for buying a car.
And in reality, it's much stronger than that. If you go back to the 4 and the 6% symbol versus compounding, every time he pays that $1,500 amount, that's reducing the loan balance. So that interest he's paying is on a lower amount every single month, which means those spreads are actually much better than what you're showing.
Yeah, every month that I'm doing this, that $74,000 loan that the insurance company is charging me 5% on is decreasing. So they're charging me less interest every month because it's a lower balance. See, that's the thing, folks. Like when we do these trainings, we're always giving you we're almost always giving you the worst case scenario. Like we're never showing the actual real numbers except for that one I did. Usually I'm hurting myself by showing you just face value numbers because that's as deep as most people want to go. The numbers are usually better than what we're showing on the screen. The 90-minute video, if you watch that car example in there, that sucks because we intentionally made that video suck because we want the numbers to be terrible, but it still works, doesn't it? So when you do their numbers and you run the scenario for buying a car, it's way better than what we showed you in the 90-minute, and it's way better than the chiropractor in the 90-minute video because we're using lower numbers than what you actually are going to earn because we're not just factoring in all that.
The simple interest is, the total outstanding loan.
Yep.
And it's calculated daily. So.
Yep. And your interest that you're earning, your compounding interest is also calculated daily.
All right, Jeff, if we just set up a policy in May, can we set up another without all the health checks?
Yes. 6 months.
Well,
it's actually 12 months.
Technically, yes, we should be able to.
Yeah.
It's at the sole discretion of the insurance company, but typically almost always yes.
Thanks for keeping me safe on compliance.
just set up 3 Guardian policies. Should I not borrow against them if they don't compound under it? So no. I was just talking about this, Peter. It's all good. Guardian does so. We just can't say with Guardian it's uninterrupted compounding interest, but the way they do is they adjust the dividends that are paid out on the non-loan part. And so from what I've understood and what Guardian people have told us, it ends up balancing out where
pretty close,
essentially the same. It's just calculated differently, so it's not uninterrupted, but you're all good, Peter. No worries.
And Peter, plus the reason I did the Guardian policies for you is they worked a lot better for the, I don't know if this is for the kids policies, but for the kids policies, we couldn't even do that with Security Mutual, what I was able to do with Guardian. So the direct versus non-direct recognition is far outweighed by the plan designs. And then it's just complicated. But Guardian, and I can give you a fact sheet on this, they increase the dividend on the non-used part to make up for the direct recognition part. I'm happy to jump on a call with you, Peter, and explain that, but it's nowhere near as bad as you would think. And it's actually not bad at all.
Yeah, that's good. Is the Blueprint software going to be part of being a member or additional service?
Additional service.
I have money going to a 529 plan for my kids. Can I set up a small policy for them to get that 529 plan, go into whole life instead of the 529 plan?
Heck yeah, I certainly would do that sooner than later. I'm not a 529 fan. Even though I sold tons of them as an advisor, I think they're terrible in so many ways.
Yeah, it's what I did for my son instead of whole life instead of that. Can the policy be in an LLC to operate as a lender that lends to me for my real estate LLC? Is that legal?
The answer is yes and yes, but the only reason a policy should be owned by your LLC is solely because the money that you're going to be putting into the whole life exists in the business account. So if you've got money in your business account, okay, so that's where all your money is, and you don't want to take that money out, pay taxes on it, and then put it into a policy, then you have the policy owned by the business, and then the business funds the policy, so it's just a balance sheet item. And then could you then lend money from your business to another entity? 100%. Actually, it's a pretty smart way to do it. But you wouldn't want the policy to be owned by an entity unless the entity is what, it's really a tax reason. So if you're doing that, a lot of the reasons, almost 99.9% of the time we do a COLI policy is because the money that we need to fund the policy is inside of the inside of the company, and we don't want to pay tax on taking that money out as a distribution.
Are the interest rates or dividends higher for a direct versus non-direct? Are there economic conditions that make direct more beneficial? No, it's just the way the insurance companies operate. There's, the non-direct is always going to be the best because you have truly uninterrupted compounding. But again, at the end of the day, that's not usually a really determining factor. It's more like Chris was saying, why we would use Guardian over SML, depending on the situation of dump ins and cash value and ultimately what the goals of you, the client, are. And that's what dictates where we go with it. So
there's really a couple of reasons we would use Guardian, and I'll just pull the curtain down. I mean, number one, you live in New York, like me. I live in New York. So we have two options here in New York. We have Security Mutual, which I have a Security Mutual policy. It works really well. And then Guardian. So Guardian allows us to design policies with higher early cash value. And they tend to have a little bit more cash value than the SML policies do in the early years. So that's reason number one, is you got a little bit more money to use than you would with Security. But the real predominant reason we would use Guardian over SML is for kids policies, because SML, for some reason, we just cannot design a good kids policy. I mean, we've tried. It's just, I don't mean to say that they suck, but they're nowhere near close to as good as a Guardian policy. So for kids policies in New York, or even kids policies outside of New York, a lot of times we do use Guardian because they just pencil better, and we can get more creative with the design on a Guardian policy. So Will said, what are your thoughts on bragging about how many long-term clients you have who have loans for more than their total premiums? No haters can counter that. I don't know the math on that, Will, but I would have to say, based on what we teach, a majority of our clients that are beyond their 5th year in their policy have more loans out than the premiums they put into the policy. But you're right, Will. Like, I guess that's, damn, man, Stephen, we never talked about that. How many of our clients actually have more money loaned out than they have in total premiums paid in? I don't know. I mean, I bet you any of the people on here who have policies, if they're over 3 or 5 years, they're going to say yes to that, because that's just always how it's going to work. And you're right. No haters can counter that.
But if you have 100,000 in a policy, 100,000 in a HELOC, but you're in the process of paying off debt and you owe on your mortgage, would it be intelligent to use the HELOC to pay off the mortgage, lend money from your policy to pay off the HELOC?
I mean, I can't say that that wouldn't make sense. It just comes down to running the math. And that's what Craig's software will be able to do. You're welcome to set up a call with Craig and, discuss that with him, because that seems like that would be a fairly simple scenario. And on a $100,000 policy, I mean, I'm sure he would probably love to do that just to kind of test the software. That's a good one. Hit him up on that. That's a unique scenario, and that'd be a great case study. I mean, how many of you would love to see a training on that? Right? Like, you'd love for us to pencil that one out mathematically. I would. So on that, I mean, I would pay Craig, his time just to create that for you, as long as I could use it as a case study. I wouldn't use your name or anything, but that's definitely worthwhile for me. From
Duck, tell them about how I'm going to buy a car with my credit card for points and then use my IVC to pay off the credit card.
Oh, so this is awesome. So I gotta clear the screen. So right before we went live, Duck was texting me, and he always bounces things off me. He's like, hey, Chris, I got this idea to do this. What do you think? So, for any of you that don't know, Duck is a car collector. So he loves buying, I'm just going to use this like an Eldorado, like a big old, does that look like an Eldorado? Like a convertible Eldorado? Not bad, right? Pretty close.
I like it.
Whatever, I don't know what kind of car he's going to buy, but let's just assume this is a Cadillac Eldorado, hence the big old front nose. So what Duck is saying is, hey, Chris, over here, he's got his policy. So he's got his whole life with cash value. Let's just say this, I don't know, let's say it's $30,000. He's saying, okay, Chris, would this make sense? I've got a credit card that has $30,000 on it that I get points for. I'm going to buy the car using the credit card. I'm going to get the points. That's $30,000 of points. And then in 30 days, he's got to pay that credit card off to not have any interest. Then what he's going to do is he's going to take the payment, okay, for the credit card. He's going to take that out of his whole life. So he's going to take a loan from his whole life for $30,000. That's 5%. He's going to pay off a credit card that, if he didn't pay off, would probably charge him 25%. And then what he's going to do is figure out what the payment would be on this $30,000, and he's going to roll the payment back to the whole life. And I don't know, let's just say, because I just did this, 7.75 is a used car loan right now. So let's say he then puts the payment for a $30,000 loan, probably $800 a month, back into his policy. How many of you are penciling this one out? He gets all the points on $30,000 for buying a car. he makes a spread between 7.75 and 5%, plus his policy. His policy's got to be 4 years old now. And he's got one of those heck fees. So his policy's cranking. He's making great money on his policy because it's always been compounding. How many of you love that? But if you screw up and you don't pay that credit card off, do not come back asking me why this didn't work. It's because you didn't pay the credit card off. What's the best credit card? Is it that Chase Sapphire has a really good rewards? We use that for the corporate stuff. And then Amex is always really good for points. I use the Amex Delta because I fly Delta, and so does Steven. We love Delta. And we use that card for just about everything. It's pretty good for airline points.
See, there's a whole world out there if you want to get into the credit card point game. It's pretty amazing. I don't have time for it, but the people I know that get into that, it's pretty cool what they can do. I try and use my points like you, Chris. I'll get either Delta miles on my Delta card, or I'll convert points from my other Amex whenever they run promos for Hilton. So they're like 3-to-1 Delta Amex to Hilton points, and that usually ends up for some pretty nice stays. And then you can do things like convert them to Best Buy and Apple and stuff like that. All right, I have a 403B that I have to roll into an equivalent retirement account because of change of job. Can I move those funds into the IBC strategy, or is that incompatible?
It's incompatible because you'd have to pay tax on all of the 403B money, but you can still do everything we're showing you if you move your 403B into a self-directed IRA. I'll have Steven give you a contact for Horizon Trust, which is who we use, and Brandy.
Just email me. Yeah, just email me and I'll connect you guys so they know you're coming from us, and they'll hook you up. So just send me an email and I'll connect you with the right person.
You'll love that, Kel. That'll work really, really well for you. And you won't have to pay any taxes on that until someday later when you take income from that.
Man, and should I transfer my policy ownership to my family trust?
I'm doing that right now. As a matter of fact, you know that Guardian policy I said? It's issued. So I got to wait for it to issue and everything to go through. And then I'm going to do a change of ownership and then move it to the family trust. Now, my family trust, so you got to be careful. It's got to be the right kind of family trust. Mine's a federal trust. Mine's an irrevocable trust. So I'm going to change ownership, have my trust own my policy. But that means that policy can only be used for things that fall in the context of what my family trust can be used for. So this particular policy that I'm doing, and you know, you can use yours however you want, whatever you're using your family trust for. I'll use this policy to fund Vivi's private schooling. I'll use this policy to fund any renovations we do on the house, like remodeling, bathroom remodels, because it's a family trust and the house is owned by the family trust. But the coolest part about having it owned by a family trust or a properly structured trust. And I preface that because not all trusts can do this. I want to be very clear. I'm not giving any recommendations or any advice on trust. Seek out a good trust attorney if you're going to do this. But my trust is properly set up. So when I have my trust owned by my family trust, the premium deposits going in $2,000 a month, plus my family trust is doing a $20,000 dump in. Those are tax deductible to my family trust. Ching, because the trust corpus owns the policy and is also the beneficiary of the policy. So therefore, the premiums being made to that life insurance policy inside the trust corpus are a tax deductible expense.
Hey, Chris, you know, the people that stuck around here were past the time. You want to, if anybody wants to come to the next 3-day, you want to give them a little special offer real fast? Because we will have people talking about trusts.
We've got 131 people. Let's give them a special offer for the next 3-day.
Anyway, so we do a 3-day, if you're new to this, we do a 3-day training maybe 3 times a year, and it's our flagship. It's all virtual, so it's nice and easy from the comfort of your own home. We record the entire thing. We give you the recordings literally that night of or the next morning, so you can catch up if you miss anything. And the lineup is stacked. I'll say we do have it ready. The dates on this website are wrong. The next dates are November, right? November, the first weekend in November.
So I don't remember the dates.
I got it right here. It's November the 3rd, November 3rd, November 4th, and November 5th. But if anybody wants to buy a ticket just now while you're thinking about it, go ahead and buy the ticket now, and we will we'll get you everything over. But just in case you don't want to miss that, it's a good one coming up. But just thought I'd mention that real fast, since we just decided to throw one more in before the end of the year.
Yeah, so
that's
going to be a really good 3-day. And it's going to come at a really good time, being end of the year. There's a lot of things happening, and it's going to be heavily, this next 3-day, we're going to heavily focus it on a lot of tax strategies along with trust strategies and IBC. So it's not going to be that it's going to be extremely advanced, but we know it's year end. So we're really going to be planning a lot of the trainings in there to be things that you would really want to learn before the new year comes in.
Yeah. Do you want to maybe throw one of those new cool shirts or something? I don't know, just throwing it out there, you know.
What's that?
Maybe throw in one of those cool new shirts, or
listen, we could give them one of the unicorn shirts. Here, just whatever you want to offer it right now, and I'll pull it up and show them what they can do. They can go, if they get it, you're going to have to manually do them.
Will Shauna yell at me?
Probably, but that's okay. She's not on here today, I don't think. Is Shauna here?
If anybody goes and buys a ticket right now for the 3-day, we'll mail you a shirt. Just in the little note box when you buy, just give us your address or email me your address and we'll get you a shirt.
Yeah, that's really good. I'm trying to, here, I'll pull it up here real quick. So you guys, you know, and when you want to pick your shirt, you can just go to chrisnaugle.com and you can come down and, you know, like we got these all new ones, the Thrasher shirts. These are pretty badass. Like these are monologue shirts that we're doing with different sayings. You know, you got the Dexter, you got the Cash shirt, and then you can go to view all and there's even more. I don't think she's got, I don't see the unicorn one. She's got to get that up here. So I'll get on her. What's that?
Maybe it's sold out.
No, I just don't think she's uploaded it yet. But we got a bunch of new ones coming on, but these are all brand new shirts. So you can pick any shirt you guys want if you sign up for the 3-day. And then Duck had asked over in the chat, is there any, IUL, Imaginary Unicorn Life shirt? That's awesome. When I'll get her to put that up. But Duck was asking if there's any specials for the experience. There is not. And that's because the experience, we only have 3 seats left. So it's $5,000, you know, for one person. But if you bring a guest, it's, I believe, half off the second ticket. So you just go to Stephen, if you want to put that link up for the experience. But yeah, we never discount the experience tickets. However, if someone wants to pick up those last tickets, I'll give you a shirt and a hoodie, you know, from the site. So you just email us the address. Happy to do that.
Vegas, baby. We got some cool stuff planned for it too.
Oh my gosh. Here, while we're going, let me get through the rest of these questions because they're coming in. You guys' questions have been on fire today. I apologize. I didn't get to the next round of like what I said I was going to do in the training, but we kind of did because your questions led us there. So Anonymous or, you know, whoever that is, I am just learning about this. 2 months ago was divorced with 6 figures out, unsecured debt. I'm looking at personal Chapter 7 bankruptcy. Will I still be able to do this? So the answer would be, do this before you file for bankruptcy. So definitely get your policy in underwriting before the bankruptcy goes through. That's very important because if you file bankruptcy, no, you will not be able to get a policy for, I can't remember how many years they make you wait after bankruptcy.
All right, we hit these real quick. If you put down 50,000 in a policy, you have to pay 50,000 each year?
No.
Nope.
So if you put 50K in, we could do that as a dump in. The minimum amount would be about 6,000 and it's age dependent. So 6,000 to 10,000. So if you did 50K in, you could probably build a policy for $6,000 to $10,000 a year after that.
And then even on that, if something happened financially, we can even lower that way down.
Oh yeah. And then this can go down by another 60 to 70% after the first year.
What about seniors, people who might not qualify for life insurance?
That's a tricky one. I mean, there's a lot of scenarios. You could insure somebody else. So somebody else could be the insured and you could be the owner of the policy. That would be worthy of a phone call, jumping on with our team to kind of talk that through. There's a lot of options for seniors on how you can actually own the policy. But if you're not healthy or you're over, I'm just going to draw the line at like 74, it gets tough to get a policy that actually makes sense. Oh, so somebody did say, oh, yeah. All right. So Sean has got them in the catalog. It's tricky. So if you guys want to see all the new shirts, they are on there. So she did upload them, but you got to go to catalog. I guess that's where I was missing. So there's home and catalog. So you go to catalog and it's going to be on there. And this is where all the good stuff is. So you got like the Blast t-shirt. Everybody wants some shirts. Got the koozies, the mugs. Where is that son of a pup? Oh, there it is. The Imaginary Unicorn Life. Look at that. Oh my God. 1999. You guys all should literally have this shirt on. If you're going to the experience out in Las Vegas, every one of you need to have that shirt. We should make that mandatory. So there's the Imaginary Unicorn Life. Thank you, Tess, for helping me with technology on my own website. She put the link in the chat. Oh, thanks, Jill. I didn't catch that. I was too busy, I don't know, talking, drawing pictures, or doing whatever. But I know we're a couple minutes over. It's pretty awesome that there's still 129 people on here. So thank you to all of you for sticking around and giving us your time. This is a really fun training. I mean, what we're designing and what we're building for all of you with this new program called Blueprint, which is going to be kind of like D4 and Blueprint coming together. We've got some really amazing things that in this space have never, ever been created. And we barely even talked about Private Money Club, and what's coming in Private Money Club that Aiknot's team is designing is literally next level too. So to say that this team, myself and everybody here from Money School and Private Money Club are excited is an understatement. What you're going to be seeing in the next 6 months is going to literally be transformational. And you're probably like, wow, how could you guys even do more? You're already doing so much. Well, we are, because we're always pushing the envelope. You know, we have competitors. So there's new people entering the IBC space, and we got to get so far out in front that they can never, ever catch us. And that's exactly what we're doing. And we're putting resources into making sure that we are going to be the leaders in this space, not just this year or next year, but at least for the next decade, until we get so tired and so sick of it, which may never happen, that we allow somebody else to get close to us, and then we'll just hit the rocket boosters and blast out again. But with that being said, thank you, every single one of you, for what you do, and we'll see you this afternoon at 4:30 for the Ask Me Anything. Make sure to get on Ask Me Anything happy hour. You subscribe to my YouTube channel at the Chris Naugle, and then you will be notified. So let me just kind of show you this, because a lot of people still don't know how to. They're always asking us, how do I get on WTF? You go to the Chris Naugle website, or sorry, the Chris Naugle YouTube.
Money is everywhere. It's very easy to.
Which is just at the Chris Naugle. And when you're on here, what you're going to do is you're going to subscribe to it. Now I'm already subscribed, okay, to my own channel, but you'll subscribe, and then there's a little bell, and you're just going to click the bell, and that's how you're going to register for the site. And we're putting new content up every single day. So every day there's new stuff. There's the bell. So you just click the bell, and that will notify you, so that every single time we put out new content, you'll be notified. And that's how you do it. With that being said, thanks everybody, and we'll talk to you soon. All right, so I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.